Hello there friends. In this very short video we're going to be talking in terms of what are called the open market operations by the central banks with a view to keep a check on the interest rates, on the rates of inflation. And today at the beginning of the trading day we had this official press note emanating out of the Reserve Bank of India that the bank shall be entering into open market operations to the extent of 20,000 crore rupees in tranches of 10,000 crore rupees each very shortly, with a view to inject more money into the hands of the banks. Now, what really is this operation like? As we all know, various banks, as a part of their statutory liquidity ratio, are holding securities of Government of India, also of the various state governments, but this is going to be dealing with the securities of Government of India of different maturities, where the money of the banks is parked with the Government of India at an auction rate, 10 years paper, 20 years, 30 years paper, and the banks are regularly getting interest from the Government of India, and at the end of the maturity of the paper, the money comes back to the bank. Now, what the Reserve Bank of India felt, and that is evident from the background of this announcement, is that the interest rates are hardening. In other words, people now require medium-term funds, 5-year loan, 7-year loan, 10-year loan, to put as investment into the business to expand their business as we slowly crawl out of the lockdown on account of COVID. But since the interest rates are going up, it really means that the banks do not have in their coffers long-term funds to then advance to various clients. So here is where the Reserve Bank jumps in. It says, hey banker friends, this is 20,000 crores coming out of the Reserve Bank of India treasury, and we are going to purchase those securities. And when we purchase those securities, obviously you pay money. And to whom do you pay the money? To the banks. And therefore, banks are going to get rid of those securities and get money from the Reserve Bank of India. And that money is medium-term to long-term paper. In other words, if you see the press note, the securities which are maturing in year 2024, 2027, 2030, 2032, therefore the tenure or the remaining tenure, anything from 4 to 12 years, that is the type of money which Reserve Bank of India is going to buy. Of course, it is a kind of a limited auction process where the bankers sit, and depending on the market rate prevailing, the Reserve Bank accepts those bids, and what then happens is those securities come to the Reserve Bank of India, and those 20,000 crore rupees will go to the banks who were holding the security. So therefore, the theory behind this is that those particular banks must necessarily then have those 20,000 crores within a period of less than a fortnight, and it would be expected of the bank managements then to lend, if not aggressively, at least enthusiastically, to projects that need the money. So that's where those 20,000 crore rupees is going to go, and it is expected not only funds would become available to the banks to lend to the entrepreneurs, at the same time it would help in depressing the rate of interest. Otherwise the cost of money, if it's high, then to that extent the projects of the entrepreneurs become non-viable. Something very important which we miss out, and this question is not asked, is it government borrowing? The answer is no. It is not any fresh additional government borrowing. That is entirely a different subject. No money is going into the government coffers. The government is itself not borrowing any money directly from the open market, the banks, or from the Reserve Bank of India. All that the Reserve Bank is doing is buying those securities of the banks. And now as far as the central government is concerned, instead of paying those installments and interest to the banks, it is going to be paying that to the Reserve Bank of India. So the government of India's balance sheet in terms of its own liabilities is unchanged. It will continue to service the debt as it was doing qua the commercial banks, but now it will do qua the Reserve Bank. There was also a small note that while it is going to be purchasing these securities, when you purchase, you pump in money, it is also going to be selling short-term securities to the banks, something which is going to be expiring in October and November, essentially equivalent to the fixed deposit receipts of the banks from 46 days to 90 days. Now, what does that really mean? That meant that the people, depositors like you and me, are putting their money into the banks for a short period of time. They really want to take an informed decision later. They are not going in for a 3-year FDR. So they're putting in the money into the bank for 46 days, for 90 days, and the bank really does not know where to park those funds. There is something of a window which is called as reverse repo rate by the Reserve Bank, but that is basically where the banks park money overnight. So what the Reserve Bank perhaps had noticed, that while the long-term interest rates of the bank loans were going up, the short-term money, the interest rates were low. So there was divergence between the two. And it is not a good idea to have too much of divergence. So by selling those securities, it is creating a window for the various commercial banks to park their short-term funds with the Reserve Bank of India. So that is going to create a kind of a stability in the short run as well. So a very, very balanced, prudent and timely interaction by the Reserve Bank of India, illustrating the open market mechanism. In summary, let me again, to end, the central bank or the Reserve Bank in open market operation is going to purchase those securities. Those securities are already floating about in the market. It is an instrument between the central government and the various commercial banks. So when it buys, it pumps in money. Where does the money go? The money goes into the coffers of the banks, and they have more money in terms of medium to long-term funds to pump in to new investments as loans, which is the business of the banks, whereas the balance sheet of the central government is unaffected. Their debt servicing will continue as usual. Friends, there are other instruments of monetary policy. We'll be very shortly talking about them. For instance, very popular in America, quantitative easing, and something which is very popular in India, what you call as monetizing the deficit, which is also sometimes called printing notes. We'll be talking about these later, but if you want to keep yourself informed and apprised of these interesting short videos, please do not forget to subscribe, click and share. There may be friends like you for whom the open market operations appear to be Greek and Latin, but actually it's a very simple concept, and it is always good to know what is the story behind the headlines. Stay connected, stay tuned, stay safe. Thank you.